Welcome to another episode of Catalyzing Radical Systemic Change, where in my own words, it's all about discovering, mapping, and cross-pollinating what I think are the necessary building blocks towards manifesting a planetary civilization in this lifetime. So I actually got recommended the work from Graham Boyd, who is my today's guest, from various sides. So I basically bought the book and I read it, and then I got really excited because since I'm also involved in large scale or even ultra large scale projects, and one of my core roles is allocating the capital into these projects, I thought let's have him as a guest on the podcast. And before I hand over to you, Graham, what I find really interesting, I would coin myself a rather educated person. So I'm pretty geeky and nerdy and stumble over so many concepts. But truth be told, the main hashtag or the very prominent work in your biography that led towards this, let's call it's more than an investment hypothesis, but it's also the core function of your investment hypothesis is the concept of ergodicity. So what I find really interesting is you basically say in uncertain times, if we continue the way we invest into projects, even though they are coined, for example, impact investing or ESG investing, and that may move the needle slightly, you really aim at I would call it a paradigmatic shift in investing. So before diving deeper into the concepts and the prototypes and where you're standing with the whole ecosystem, it's kind of a pattern of my podcast that I want to show the full human being so that people do not only tune in from their minds, but also allow to tune in from their hearts. So like always, the first question in my podcast is, Graham, what are the pivotal moments that connect you to the topic of today's podcast? So Graham, super grateful to have you on the show, and the floor is yours. And I know you have such an interesting biography, when we prepped the podcast. So yeah, curious how you tie that into the topic of today's session.
Wonderful. Thank you, Alistair. I'm really looking forward to this conversation. And it's very timely, as you say, because what we're bringing in is something that is very new, at least in the world of investment and business, and yet very, very powerful. So if I say a bit about how I got to where I am, I was born in Africa, grew up in South Africa, and grew up in South Africa during the apartheid era. And that's given me a very deep understanding of how, when you take normal people and embed them in structures, in ways of behaving that are regulated and that lead to this kind of behavior, how difficult it is to get different outcomes to the ones you're currently getting. And that's very relevant to what we're doing today. My thesis for the past 16 years since leaving Procter Gamble has been, if we want to have fundamentally different outcomes from our investments and our business operations, we need to build business and do investment fundamentally differently. We can't just put small improvements onto the same structures. The other side of my early life was really being very curious about how does everything work. And I ended up going down the route of studying theoretical particle physics. I could have gone down psychology. I could have down almost any other route because I was curious about everything. And that took me from South Africa through Germany, where I did my PhD. And as a taster, I did my PhD in non-ergodic processes in high temperature particle physics. So the whole question of ergodic and non-ergodic dynamics has been part of my life since my early 20s, and it's fed my intuition. The other thing that particle physics has given me is a way of looking at the world and asking myself, if I want to change the bulk properties of something, one way of doing that, and a necessary way if you want to do it easily, is to go down to what are the smallest particles and the way they interact, and what changes can we make at the level of the smallest particles and how they interact. And that links to the world of business, because the smallest particles in business are things like the company itself, the people inside them, the share certificate that governs the interaction between the corporate person and the investor person. Those are the things that we need to change if we're going to fundamentally change the outcomes we're getting. So these are how some of the things have tied together. As a physicist,
I'm super curious. Let me tie into that, because some of these podcasts are more type interview, and this one I think will be more a dialogue. So what I find very interesting, and which got me really excited, and a lot of people around you, because I mean that book is actually really circulating the planet, and you're opening a lot of doors, is when you look at the way, I would say, nature is built from the smallest particles on, there seems to be a concept which is coined ergodicity, which doesn't come from you. It comes from particle physics. And I'm just curious, can you explain like a ergodic versus a non-ergodic system, and maybe choose an example from physics and then maybe another one from business, just to almost create like the boundary conditions so that people know, that is basically one of the core nuggets of this podcast to take away straight from the beginning.
Yes. Perfect question. So the first core nugget to take away is, before I unpack what ergodicity and non-ergodicity is, the first core nugget to take away is that everything that we deal with in business, almost everything that we deal with in life, well, let me say almost everything, that you can find a couple of peculiar, rare things in business, but almost everything throughout life, including business, has non-ergodic characteristics. However, what we're taught in business schools is assuming that we live in a fantasy world where there's no difference between ergodic and non-ergodic. So that's the first key message, is that a lot of what we're taught in business schools is simply an excess. A lot of what we're taught in business schools is a premature simplification of how business really works. And that leads us astray in how we navigate businesses, how we choose to invest, the decisions we make. And it leads us further astray the more the world we live in is filled with unpredictability, uncertainty, volatility, and risk. So let me now unpack what it is. Now, first of all, this concept of ergodic and non-ergodic is not simple. Let me preface that. It's not something that is easy to understand, and there's nothing that I can give anybody where they will immediately say, after a 30-second pitch, this is exactly what it is, I fully understand it. This is something like being a good accountant and mastering double entry bookkeeping and all of the nuances of accounting. That's a long study. So the simplest I can give on something, the whole question of whether it's ergodic or not ergodic deals with how something changes over time. So that's the first important bit. We're talking about how something changes over time when we're asking the question of, does a business behave ergodically or does it behave non-ergodically?
Can 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 I interrupt you there? Because I mean, the normal thing, at least I was told, so I come from macroeconomics, and already at the very beginning of the studies, I'm like, okay, this is like oversimplifying the complexity, certainly of the times we are in, because it's clear we're crossing most of the planetary boundaries. That's not part of the conversation. Most of the listeners will simply agree. But we treat our macroeconomic assumptions pretty much as a given. So,
Yes.
despite knowing that infinite growth fueled by consumption of resources can't go forever. So we're basically hitting a wall there. When we talk about the predictability of a business plan, I handed in like various business plan. Everybody wants to see a hockey stick. I'm helping to match capital for various for-purpose, for-profit endeavors, and every investor wants to see a hockey stick. It's a super funny thing because everybody knows you can't really predict that, but okay, sure, ideally you have a business model, you have a product market fit, then you have like this, let's say, the zone where hopefully you're lucky and you get some angels in, and they bridge basically that valley of death, right, where you burn cash before then you make a decent profit margin, out of which then you need to satisfy the investors. Can you take this super simple textbook example from myself to tell me, where would ergodicity versus non-ergodicity maybe change the way investors look at a business plan or a pitch deck?
Yes. Perfect question. So the typical business plan is constructed by, first of all, looking at all of the different drivers that you can think of that will affect the growth rate. And so you come up with an average growth rate that is an average of all of the revenues that will come in and the growth rates of those revenues, all of the expenses and other causes of cost that will cause losses. And the standard rule of thumb is, so long as the average of all of the average of the growth rates of the revenues and the average of the growth rates of the costs, so long as that average is healthy, in other words, positive, then you have a good business. And let's say a typical hockey stick for an early stage startup, you might calculate these averages and say, right, on average, we expect this business to double in size each year. And that's going to give us a very nice hockey stick. And this is what unicorns are after. They're looking for a business that will double in size each year. And as long as it can hold that doubling in size growth rate for 10 years, you're going to have a good unicorn coming out at the end of that. The assumption hidden behind that is that if you have this average growth rate and it's healthy, in other words, the average growth rate says it's a really good investment decision to invest in a business that on average grows this amount, then don't worry if for a couple of years the business is shrinking, because sooner or later, if you just keep going for long enough, the business is going to trend towards the average. That's deep inside neoclassical economics, that everything trends towards the average. That statement, it trends towards the average, is only true if the world is ergodic in how things change over time. In a non-ergodic world, things do not trend towards average. if you keep going, you will not recover the losses necessarily. And in particular, with the nature of how capital grows, how valuations grow in business, the non-ergodicity is always on the downside. In other words, in a volatile, uncertain, unpredictable world, business growth trends towards significantly less growth than the average growth rate. And in many situations, whilst your average growth rate is positive, your typical growth rate in a non-ergodic world is negative. And this is a key reason why businesses that look healthy on paper go bankrupt. This is a key reason why investors have a unicorn strategy and so many investment funds underperform. And this assumption that the world is ergodic is part of why economics believes you can have infinite growth on a finite planet.
Yeah, I mean, what I find very interesting, I'm only now 9 years into, let's say, early stage startups and capital allocation. So not that long. But what I find really striking is seemingly the vast majority of investments made work under assumptions that have not really changed since post the Second World War, right? At least not since the late 70s, early 80s, when the classical 80-20, Silicon Valley VC business model really kicked in, which is striking because the hunt for the unicorn is a secondary effect of the empirical proven bell curve that 90% of all early stage businesses fail. So when I'm an investor, so I'm not an investor, but I'm invested into the portfolio companies I'm building, and hopefully, I hope, not all of them, go bankrupt and make it. But it's really crazy to assume that like 90% of the business endeavors will default. And hence everybody's hunting for that unicorn, which then artificially pumps up, especially after IPO, the value of some of the businesses, but most of the untapped potential in the ecosystem. So when we talk about the regenerative ecosystem, it's really striking. So many people that are seemingly well embedded into an ecosystem don't satisfy the paperwork and the diligence of classical investment cases. But I think from an ecosystemic perspective, since I know you want to get a whole ecosystem off the ground, and when we look at it from a different perspective, this investment into a whole ecosystem may very well perform both better, more long term, and have less default into the ecosystem. So before we dive into examples and where your ecosystem is standing, your own learnings of how to apply that methodology into your ecosystem, can we nevertheless still try to define ergodicity versus non-ergodicity, just for the sake of the listeners being able to follow us once we dive deeper?
Yes, I'll give you another example. So keep in mind what I said, that a system is ergodic if it trends to the average over time. It's non-ergodic if it trends away from the average. Almost everything is non-ergodic. And one example, which is an extreme example, so bear with me on this, is let's take Russian roulette. And if we go to a village with 1,000 people in the village, and we say to the village, everybody plays Russian roulette once. And if you survive, I'll give you $1 million. Well, on average, 830 people of the 1,000 will survive one round of Russian roulette. So at the end of the game, on average, the village will have $830 million in their village bank account. Now, this is 1,000 people playing Russian roulette once. And the average of that is a good deal for the village, at least financially. The rational economist will say, yeah, this is a really good deal. The village should take that offer. This is a good business decision for the village to take. Now I come to you and I say, instead of 1,000 people playing Russian roulette once in parallel, I play Russian roulette with you. Now, I don't actually play the game. I'm just giving you $1 million each time you survive, but you commit to playing it at least 1,000 times in succession. According to an economist, there's no difference between the two. But you and I know perfectly well that would be really dumb to do. You play it 1,000 times in succession. The chances that you're still alive after the 10th round is close to zero. The chances that you're still alive after the 500th round is, for all practical purposes, zero. And the 1,000th round, I'm almost certain to have my money back.
I love extreme examples. Let's stay with that because I think that's a good segue into, instead of optimizing for a small portfolio, it's actually investing into an ecosystem which consists of, let's say, at least a couple of dozen, if not a couple of hundred data points, strategic investors, strategic partners, major shareholders, advisory board, anchor investors, all with different needs, with a different, let's say, center of gravity of consciousness in their value stack. So I find that strikingly interesting. So basically, mainstream economics says playing 1,000 times the same game or playing it 1,000 times with 1,000 different people doesn't make sense at all, which is obviously dumb, plain bullshit, because like you said, there's hardly a chance in the whole universe I can play 1,000 times Graham Boyd and Alistair Langer, like Russian roulette, and I survive. Whereas the economic rationale from a neoclassical theory standpoint would be it's the same chance. Do you mind translating that into the context of maybe a fund or a family office or an institutional investor, just that we have a good segue ultimately in what you really like, the scale of the magnitude of what you want to get off the ground?
Yes. So starting here, the standard principle behind business planning is that we can look at playing Russian roulette 1,000 times once with 1,000 people and use that to estimate the growth rate of the business and then apply that for 1,000 weeks into the future, repeating it. And so the same error is happening inside this. Now, what the portfolio strategy that investors currently use and the emphasis on finding the unicorn, what that amounts to is hoping that instead of playing, if an investment fund was doing this, instead of just investing in Alistair and saying, right, we're going to play Russian roulette just with Alistair in sequence, what the unicorn strategy amounts to is saying, okay, business is a game over time. If you just played it once, it would be gambling in a casino. Business is a game over time. So we recognize that the chances of Alistair surviving Russian roulette 1,000 times in sequence is almost zero. What we're going to do is find 1,000 Alistairs. Each of them will play Russian roulette 1,000 times in sequence, and we will put 1,000th of our money into each of them. So instead of you getting $1 million each time you survive, you get only $1,000 each time you survive, but that's spread across all 1,000 copies of Alistair. And the unicorn strategy is a strategy of luck. It's just hoping that you will have enough Alistairs playing the game that one of them will be lucky and will keep getting money for long enough to repay the amount of money invested in everybody. And that's, strange as it may seem, when you look at the unicorn strategy of investment, the modern portfolio theory through this ergodicity lens, it boils down to a strategy that relies on luck. And as anybody who's been to business school knows, luck is not a good strategy.
Yeah, I mean, it's striking. I mean, I hope many of the people that listen to this podcast, just get like, oh wow, that's actually how investment is done. Yeah, in most of the cases, and people slightly try to tweak that gambling approach. So I wonder what's a good segue from how do you want to change that? How do you want to get a whole ecosystem off the ground? What are the prototypes and experiments that you have currently running, and what does the data support you, like an empirical data does support you, that actually your approach, which is a deep paradigm shift, actually really like hedges against the default risk, but also, funnily enough, creates more return and more stable return on investment.
Yes, perfect. So, and for people listening to this, this is the key message out of this section, is that investing through or using an ergodic strategy for investing gives you a double-sided hedge. It's hedging for opportunities. You can take more opportunities and do better with them, and it's hedging against downside risk. Another way that you can think of this is that it's simultaneously an alpha strategy and a beta strategy. It's not saying you have to choose either a beta strategy, which is good at wealth preservation but cuts down the potential upside, or an alpha strategy. It integrates them. So the heart of it is, in a non-ergodic world, the consequences of negative shocks to a business or to an economy are far more consequential than is taken into account in business plans. So the heart of an ergodic strategy, what that ergodic strategy means, is recognizing that the impact of unpredictable shocks is bigger than we take into account. And so we have to do something that is counterintuitive in normal business thinking to protect against those losses in a way that will give us more upside potential as well. And those counterintuitive things, there's a range of them. At the simplest level, it just means that companies keep a working capital that is, say, at least 12 months worth of operating costs in their working capital, not 3 months. So that if a shock comes their way, they have enough time to recover from the shock and get back to profitability before they need things like an emergency line of credit or another injection of capital from their investors or whatever. And that means that companies begin paying out dividends as a startup later than they would otherwise do it.
So that's the conservative part of it.
Yes.
That's the conservative part of it, which I think from just common sense makes sense, because
Yes.
who but investors would look at a 3 months horizon? I think every normal being would love to have like something like 12 months of a runway of security, of at least 1 year of a short lifespan, 85 years or something like that on average, or 82. I don't know what's the worldwide average lifespan. I hope I count on 85 still. And have 12 months of security, and not basically artificially pump everything out of that security into growth. So this one I get. So hedging against, let's say, the default loss. But how do you pair that? Because it seems almost like a yin and a yang, like a dichotomy.
Mm.
How do you pair that with a bigger potential upside?
Right. So this is now where you go to the optimum ergodic strategy. And what's counterintuitive here to get optimum upside potential and optimum protection against downside risk is that you bring groups of companies, diverse groups of companies in different product sectors with counter-cyclic responses to a given shock together into an ecosystem, and all of the companies commit to putting a certain percentage of their profit each month into a central pool, and that pool immediately gets divided out again according to a formula based on the expected performance of each company back out to each company in the ecosystem. So,
Makes perfect sense. I mean, to look at it I come from a gardener's family, so with that background, it becomes perfectly suited. You have some trees, you have some bushes, you have some perennial plants, you have some plants that grow and die every year, and you take the same amount of humidity that within the mycelium system just creates a optimum of access to, let's say, in that example, just water, right? And if you replace water in that example with working capital or risk capital, then that's the pooling of the money. So from an ecosystemic perspective, I totally get that. So what I find interesting, since you're really opening so many doors, is what is the pitfall or the thing that you're fighting with? Because if I heard as an investor, you can both hedge against alpha and beta strategies. So you hedge against defaulting, but you also create a higher alpha. I mean, people should basically just ask you for, okay, Graham, where can I please sign the check? I mean, this seems too good to be true.
yes, I'd, I'd say two things in there. The first bit is that this is something that is so opposite to what is being taught in business school, in investor training. It's so counterintuitive to the unicorn idea that everybody I talk to, even the ones who are very receptive to this on the investor side, their first reaction is, but this can't be right. This has to be wrong. There's something wrong in here. And so that the challenge is to take on board something that is opposite to what we've been taught and is counterintuitive, requires, first of all, accepting that perhaps what we've been taught is at least in part wrong. And that is challenging, to let go of what we believe has given us success. So that's the first part of it.
Let's
The
stay with
second,
the first part,
yes,
because what comes to mind, since I mainly studied macroeconomics, but also sociology and epistemology. So the classical thing from Karl Popper, very famous, is like the scientific paradigm, right? It seems people either need to die out or educate themselves that you need to jump from I would say, single point optimization in your portfolio, hence the unicorn strategy, to a ecosystemic portfolio strategy. Because, like you said, actually you need a broad range of companies, products, services with different alphas, different betas, different risk cycles that can hedge against different shocks to create a relative stability or resilience within that ecosystem. And again, I come from almost the other side, since I didn't study most of the mainstream stuff. So I come from the ecosystemic side, and there intuitively, obviously, it makes sense. So I wonder, from the education part, from like changing the paradigm, which Karl Popper famously stated, I don't know when he wrote this, I mean, this more than 50 years ago, usually paradigms need to die out, literally die out. People learn, and then they stick to a paradigm, and then they die, and then the next generation takes over, and stuff changes, how people perceive the world, and in that case, how they invest. When you, let's stay with, before we move into the second part, let's stay with the paradigmatic shift. What have you learned what investors need in order to crack their minds and hearts open to just consider that this scenario that seems almost too good to be true is basically just a paradigmatic shift and makes totally sense from an ecosystemic perspective?
Yes. So two of the things that I've seen that are part of what investors begin to see when they begin to change their minds. And I'll emphasize it, as you're saying, paradigms change when the old paradigm dies out. Doesn't necessarily mean that the person needs to die. It just means that the paradigm dies out in their mind. I can't change anybody's mind, but people can change their own mind. And so what I found very helpful is to tell stories of where we see this in business today and where we have seen it historically over the past centuries and over thousands of years. And depending on who I'm talking to, I will tell different stories. So somebody like you from Germany, I might point at the old Hanseatic League that was a very, very successful business operation between all of the coastal trading cities in Northern Europe down into Southern Europe. They actually used a version of this profit pooling, and it's why they were so successful in the highly uncertain and risky business of ocean trading, where you didn't know if your ship would sink or not. There are, on the other hand, if you
Can we
look
stay
at
in Germany?
mainstream,
Can we stay in
yes,
Germany? So, and we haven't prepared that, but I mean, why prepare everything? Is when I look at some of the most successful big German brands and conglomerates like Bosch and Siemens, it seems almost, and there are more, but let's just stay with Bosch and Siemens. Are there not some of the ingredients as you present in your framework that somewhat are embedded that made these big conglomerates? Some of them are the biggest companies on the planet, you know, or are amongst the, I don't know, top 500 or top 2000. I mean, Siemens is a big one, and Bosch certainly is also a big one. Have you done some research on that, of how through your lens they have applied maybe some, but not sufficiently enough of that paradigmatic shift, and how may we be able to support them of injecting more of this like new paradigmatic DNA into their portfolio strategies?
perfect question. And I look at Siemens and Robert Bosch separately. And Robert Bosch is doing a little bit better than Siemens, which is why I'll come to that. Well, they're structured to be able to do it better than Siemens. So the essence of Siemens is that they are a horizontal conglomerate of many different business units with very different kinds of products. You know, trains, turbines to generate electricity, all kinds of different products in different arenas. And within Siemens, at the end of the day, the profit, in fact, the entire working capital of every business unit gets rolled up into the top level Siemens AG, the listed company on the stock exchange. And what counts for the valuation of Siemens, for Siemens dividends to the shareholders and so on, is the profitability of the top level Siemens AG. And from a Siemens perspective, it doesn't matter if one of the business units runs at a loss for 1 year, 5 years, or 10 years, so long as it's clear that that is a temporary loss rather than a fundamentally unhealthy business category to be in. And this means that if you look at any of these multinational, multi-product companies, they're doing this diverse profit pooling ecosystem approach because they're active in multiple countries. So they have geographic diversity and pooling across geographies. They're in multiple products. So they have product diversity pooling across multiple products. And their structures, so these different products and geographies are countercyclic. And that's very much like, or this is this ergodic strategy in action. And the reason why nobody knows that is because the whole lens of ergodic versus non-ergodic in economics and investing and business is really less than 10 years old in people's awareness. And it's only over the past few years, in some sense, since I wrote my book about ergodic investing, since my book, the Rebuild the Economy, Leadership and You came out, that it's begun to become visible in business. And of course, the work of Ole Peters and his London Mathematical Labs and the Santa Fe Institute and their development of the whole arena of ergodicity economics that has become valuable. Let me touch briefly on Robert Bosch and why I say they're why they're different to Siemens. So Robert Bosch has a 2-layer corporate structure. I think it's 96% of the voting shares of the profit-making Robert Bosch business, which holds all of the other sub-businesses. 96% of the voting shares are held by the Robert Bosch Foundation. And the Robert Bosch Foundation is mandated to vote according to the principles of the foundation, which represent or which capture Robert Bosch's personal values and ethos in business. And that means that the Robert Bosch business operations are mandated to take long-term decisions for the good of the foundation rather than short-term decisions for the quarterly interests of a stock market investor.
I find it very interesting that just intuitively I sketched Siemens and Robert Bosch because I know quite a bit about them. When you were to close that section on ergodicity versus non-ergodicity with the examples of Siemens and Bosch, where do you see in both ecosystems some of what you want to birth onto this planet or bring forth better exemplified or less?
So I would say both of them exemplify very well the power for long-term growth of multiple different kinds of products and geographies coming together in an ecosystem that has a high level of collaboration within the ecosystem. And then competition is primarily between ecosystems, not so much within the ecosystem. What they do less well, though, is that these are all managed top-down. That means that the level of competition within the ecosystem is actually too low. You need competition within the ecosystem as well. You need the kind of competition that you find in the startup world of high-risk endeavors that may well fail, but are part of a larger ecosystem. And the negative consequence of that is that big multinationals are typically very slow at really new disruptive innovation. And what we need in today's world is very fast, very disruptive innovation to tackle the world's challenges. And this is where what I'm saying is very much a yes and. It's an answer to the question, how can I have all of the benefits of small agile startups and all of the benefits of big multinationals with deep pockets? And if I say I want yes and, that leads you to the kind of ergodic ecosystem of startups and scale-ups where you have all of the agility and exploration and risk-taking of a good startup. And because the startups do this profit pooling within the ecosystem, you have the scale and the benefits of a whole ecosystem and the speed, agility, and experimentation of small startups. Right. I see you connected again, Alistair. I don't hear what you're saying, although it will probably come right in the wash when Riverside uploads your side and my
All good.
side and integrates.
All good. Now you should be able to hear me. Needs
Yes.
to be cut at 46. Needs to be cut at 46 minutes. Yeah, this was always the issue with Riverside. This is why I went back to Zoom. Let's just continue.
Yes.
So we're trying to wrap up here the seeming dichotomy in between agility, which is usually housed in startup environments, and let's say the resilience of those two mentioned big, powerful, I would still say, conglomerates like Siemens and Bosch, but that often lack the agility to respond to highly volatile market circumstances and shocks. So what I find really staggering, again, it's like it makes it so compelling. So maybe to lead into maybe the second part of the conversation is from an ecosystemic perspective, it looks like simple, but not easy, because imagine you convince 100 startups in the regenerative ecosystem, everybody pools a tiny fraction, you put all of that into a holdco structure, including the training, the biz dev, some parts of the accounting within the ecosystem, then you have kind of a combination of a very agile startup type environment with the minimum viable organizational structure of a big holdco, as mentioned in Siemens or the Bosch example, without the heavy burden of whatever 16 or I have no idea how many hierarchies or 25 hierarchies in these big conglomerates. So I want to segue into the conversation because what I found interesting, one of my main takeaways is like, actually you can read that book and just have a new lens. That would be my recommendation to the listener. Just read the book. It won't take you months, it takes you a few days. And then just install that framework, how you see the world and how you approach investing or the startup environment, or if you're an institutional investor, into more the complex ecosystemic environments. I want to segue into how do you want to get that off the ground? Where are you standing? How many companies are in your ecosystem? What are the needs? Also, what have you learned? What has failed? So let's just make this an open conversation on where's your ecosystem standing, what's the robustness, and then run it through a Horizon 1, 2, 3
Yes.
framework.
Perfect. Thank you for that, Alistair. So The first thing I'll put in is you're absolutely right. This is not something where you have to do either everything together or nothing at all to get any benefits. It's a really good strategy. Read the book and start with something simple that is within what you can do. To really take it all the way and to do it in a way that is fundamentally better than, say, a Siemens on the side of the big, and with a current accelerator approach on the side of the startup, there are two things to put in. So first of all, at the startup level, one of the things that we deploy is a well thought through and evidence-based approach to actually finding the product market fit, finding the business concept, growing it and scaling it. There's a lot of trial and error. Many startups burn through the first couple of years of investment finding out how to run a startup and trying to find the product market fit. So we use an approach that has been validated over hundreds of startups to do that far more like a production line. Yeah. And just as a side comment, if you think of the failure rate in the startup world, how much money is burnt up there? If you think of the number of investment funds, VC funds, that perform less than their LPs were expecting, if we were doing that in aeroplane manufacturing or car manufacturing or in a hospital, we'd shut the operation down as fundamentally not understanding how to deal with the risks of that business. So this is what Ergodicity is bringing in, is a lens to understand a source of risks that has hitherto been hidden from sight. So that's the first one, is we build with a systemic approach. The second thing that is part of how we build, to avoid this top-down elephant, the way that we incorporate gives governance rights to other members of the ecosystem. So to prevent freeloaders, to prevent excessive money going to businesses that are inherently unhealthy and nobody can shut them down, all of the companies that affect each other in the ecosystem have an appropriate level of voting power in each other's shareholder meetings. So if company number 9 out of 50 companies in the ecosystem is fundamentally unhealthy, the other companies in the ecosystem can intervene, can vote to shut it down, or can vote to change the executives, or can come in to take over some things. So those are two of the differences. Where we are right now is that we've validated how we incorporate, how we operate businesses with 70 plus startups over the past 8 years. And we're now at the point of seeking the LPs for our investment fund so that we can really start to invest with a holding company paradigm in the startups that are validated out of those 70 and the new ones that we're building. Needless to say, many of those 70s, or many of the startups in those 70, we realized the product market fit wasn't right. So we shut them down. And in many cases, we shut them down quickly. A couple have gone steaming ahead in a really healthy way. We haven't yet brought them into a profit pooling mechanism for one big reason, which is that for the profit pooling mechanism to really start working properly, first of all, the companies in it need to be making a profit. And many of the startups that we're currently working with are still pre-revenue. So you can't bring them into a profit pooling mechanism. And those few that are post-profit, it would probably be unwise to have brought them into a profit pooling mechanism previously, simply because there wasn't enough understanding in the investment community for them to invest in these businesses and come in. So we're at the point of really starting this next phase of our business concept of starting that profit pooling ecosystem with the investment holding company that the LPs invest in that then flows into the businesses.
So I'm a big fan of the Horizon 1 to 3 framework. I think the Horizon 1 should be like abundantly clear. Install the profit pooling mechanism, the right governance in place, the holdco to equilibrate, which I really think nicely ties back into this metaphor I have in my head. Have the agility of the startups, but also the power of the big conglomerates side by side. So let's just imagine, we have a crystal ball, you get that off the ground. What's the Horizon 2?
Yeah. Right. So I would, just as a side comment, I would tend to take the example you've just given as Horizon 2 and what we currently have as standard business as Horizon 1. So maybe I use Horizon 1, 2, and 3 differently to you. But so if I take what you've said, the Horizon 2 would be that we have multiple of these ecosystem holding companies around the world with diversity between the holding companies. And then Horizon 3 would be that the entire economy shifts to this ergodic ecosystem approach with holding companies. And just as in nature, you have ecosystems at all scales. The global economy is one global ecosystem composed of smaller level ecosystems that are maybe continent or nation state in size, cascading all the way down to where you would have a smallest level ecosystem that might be the economy of one small village or town or one small bioregion or something like that. And then the beauty of that is we replicate the success strategy that nature has used to keep life going on the planet for 3.7 billion years, a hierarchy of ecosystems of different scales. We replicate that in the economy. And I don't see, if we don't do at least that, any way of having an economy that will really sustain for another century or two as we go deeper into all of the different planetary changes we're facing.
I personally, obviously, could not agree more. Maybe towards the end of this recording, what do you need? Imagine there's a magic wand. What are you searching for? Who should reach out to you? So I think the education part is clear. Read the book. You have like a ton of resources on your website that we will provide in the show notes. But what's the magic wand? What's the golden needle in the haystack to really get this ecosystem off the ground?
Right. So the biggest needle in the haystack that will really change the game is limited partner investors who are keen to try something that is systemically new, who want a systemically transformational approach to simultaneously preserving capital, growing capital, and having impact without compromising between those three. That's the next stage that we're looking for. And of course, to complement that, we're always on the lookout for founders, entrepreneurs, people who want to build businesses or be part of building new businesses to join our programs, to join the startups we're building. we're looking right now for a really good chief operating officer for one of the businesses we're building. And we're always keen for people to read the books, to look at the videos on YouTube, Instagram, and so on that we have, because the more awareness there is of this, the faster that this can become the new paradigm. And it's back to paradigm changes. This is not something that we want to own as we're the only game in town that does ergodic investing. We want everybody to shift to this approach because it's inherently better. And the more people that are using it, the more that we will learn on how to do it better, which benefits us and our investors as well. So those are my 3 requests.
I don't know if I have anything to add. So for those of you who were with us up until the very end, check the show notes, read the book, apply for being part of one of the cohorts so that you have more collective intelligence in your ecosystem. For those of you who are searching for a job, directly reach out via LinkedIn or via your personal website. And lastly, for those LPs out there who are like longer in the game and who can risk from their own portfolio strategy to make a very interesting investment where you can de-risk the default, but not compromise on the upside, I think you should reach out to Graham. Graham, thanks so much for the conversation. This was really beautiful, concise, juicy. Thanks so much for being my guest on the show today.
Wonderful. Thank you very much, Alistair, as well. It has been a superb experience for me to be in this conversation with you. And I felt that it's flowed very beautifully. And I look forward to further conversations with you over the coming months and years.
Thanks so much, Graham.
Wonderful. Thanks, Alistair.